Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter. We may also go into some ratios of GDX and some of these other ETFs to see how they are performing and how they're moving against each other. That is useful information. It usually gives me more confidence in certain sectors if they are turning, breaking a trend line, outperforming other sectors, and kind of what they look like in the short term. Again, I'm not trading on these ratios. I'm looking for new buying opportunities to basically balance out the portfolio. It's kind of like rebalancing to some extent using new money where things look good and they're cheap. I start to move more money and invest in those. And then when other things pull back, I invest in those areas to create one big balanced portfolio over time as I cost average in to what I think are the best and cheapest and most undervalued sectors in the commodity space, where I think they're all going to go higher against other assets. So it's just taking a fine-tooth comb and combing through what I think are the best opportunities and adding money where I think the money should be going at that time. So again, if you need any help with anything like that, looking at ratios, finding the value in the market, what looks good, finding individual companies for this commodity bull market. And again, we are really early in this commodity bull market still. You can check out finding-value.com, become a platinum member, use the word discount in the coupon code if you'd like to sign up. You can see all the previous platinum question and answer sessions and midweek updates. You can see when I'm buying, what my portfolio looks like on the website. And you can see my history, track record by looking at those purchase points. I don't tell you how much I buy. I just tell you what I'm buying and the price I'm buying it at. So let's dive in here, give you my financial opinions around all this. Again, if you want to follow me on Twitter, it's at finding_finance. So coming on down, Lynn Alden, I do think she's got some good insight on a lot of stuff. She says, mining polysilicon and turning into solar panels is an energy-intensive and chemically intensive process that China dominates the market share of now. This is for polysilicon. This is for solar photovoltaics. Now, here's another thing I want to comment on. The rare earth elements processing happens in China as well, and it's like 90+% in China. Why are all of the first world countries mandating that we go to these renewables, electric vehicles, and all this stuff when the vast majority of it needs to pass through China? I just think that's a huge security problem or issue. And she's obviously bringing this up as well with polysilicon and China being the main area that is basically has all the market share in polysilicon production. Here's a quote that I had written up there. It says, you can have multiple cyclical pullbacks in a secular bull market. I think a lot of people struggle with understanding this concept that are retail investors, AKA things don't go straight up the entire time in a bull market. We're going to have pullbacks. It's going to feel like crap. But guess what? That is the game we're playing. If you want 10, 20 baggers, you got to play that game. You got to learn how to play it. You got to learn to be emotionally stable. It's very rare to buy a company and not have it go down on you. It's very hard to time market bottoms. So at some point, you could see a pretty big decline in the stock that you own. If you're confident in it, a lot of the times it's best and wisest to cost average into it as long as you are in the right market conditions in a bull market. If you're not confident in the companies that you own and you don't understand the companies that you own, you are more likely going to sell it when you're at a loss, and then the company is going to go up and you're going to chase it as it goes up. That is pretty common for new retail investors to do, unfortunately. It's taken me some years to realize that the short-term price movements do not determine the fundamental long-term secular trend. So you can have a recession and a cyclical pullback for that recession in a gigantic secular bull market that is going to occur in commodities. And we could very well see that at some point this year or next year. But that's not going to fix any of the problems in the secular bull market. It's not going to fix the shortages and the deficits that we have. In fact, it's actually going to make the fundamental case stronger, because what usually happens is that money pulls back if commodities fall under that cost curve of a lot of the higher cost companies. So the supply demand is actually going to get worse when the demand kicks back on and the supply is not there. Yeah, I did a ratio video there. Check it out. Here's David Flood. He says, not to mention we are in the upward wave of the current 54-year cycle, which last peaked in 1981 and bottomed around 2008. Next peak is approximately 2035. The upward wave is characterized by rising inflation, commodity prices, and interest rates. Ride the wave. And the one thing that I can say with certainty, if you look at the charts of inflation, is it rising? Yes. Commodity prices, are they rising? Yes. We just went through wave one. We could have had a wave two pullback. If that's done, we're going to start a big wave three. And interest rates broke their long-term downtrend lines of that 40-year downtrend, 40-plus year downtrend. So all of these are valid from a technical analysis standpoint. And these are the different cycles that he has. The 18.5-year rhythm, that's the real estate cycle. That is the business cycle or real estate cycle, which is the same thing that I talk about a lot. This is the wholesale prices, possibly production and interest rates as they go up and down. And we've got the wholesale prices, common stocks with the 9-year rhythm. And then we've got prices of many commodities, securities, and businesses, which is a 41-month rhythm, which is a very short-term rhythm. So these are considered secular bull markets, these 54-year and 18.5-year, which are these rhythms. The 9-year rhythm, which is more, could be a cyclical pullback, or this guy, one of these cyclical pullbacks in this on these larger, bigger, longer term trends. We want a trend like 15 to 25 and this bigger one up to 25. That is a good trend to catch when they're all going up. So if you look, it's a bottom here, a bottom here, a bottom here, and this one's still going up, but that would be a good entry point if you can time the bottoms of this. The best point to time would be 1952, this bottom here, and this bottom here. They're all basically in alignment. And then you're going to get a surge to the upside. That is obviously everything in alignment on different time frames. So you can hear me a lot say I'm bullish on something, and I might be talking about a longer term cycle here from 52 to 61, which is a 9-year time frame, versus one of these short cycles that someone else might be looking at. They might be trading this, and I'm looking at this cycle in addition to this bigger, longer cycle up here. So different time frames, you can be bullish and bearish based off of the cycles. Here's industrial production increased 0.4% in March. I just thought that was interesting. You can kind of see this thing as peaking out here, but it looks like we're ready to break to the upside, potentially for industrial production. And I think a lot of people think that we are just going to collapse and crash to the downside, but this is holding up and it is higher. And I wanted to show that. Here's North Star. He says gold, $2,800 and beyond. We've got obviously the cup and handle. There's the cup here and then the handle here, and we're breaking that to the upside. Pull back to test a 3-year moving average at maybe, which is this guy here, the 3-year moving average, that green line. We are going to the bull power zone. Maybe we can stay up there for a while. The dump zone's on the bottom. But gold is looking absolutely excellent on a longer term time frame. And we can go into some of that with the ratios later on. Platinum, I just made this comment. I said, be greedy when others are not paying attention. Buy when others are telling you that the asset is boring and hasn't gone anywhere for a decade plus. It says the investment opportunities are in what looks to be dead, but is not dead. It is the cycle swinging back around to invest in the undervalued asset. Learn how to find undervalued assets in the markets using ratios. And I just took a monster box of platinum as a picture. What I said here is, gold is cheap to most everything else in the markets. What does that make gold and silver miners? We're sitting on some insanely cheap valuations and, quite frankly, some very rare opportunities in the markets that you will or might not see again in your life. And this is the XAU to gold ratio. Obviously, we've got a downtrend line, but the lows are stepping right into that downtrend line. We're very close to a breakout of this ratio, and if we see a breakout, this is going to be a big deal for the gold and silver mining companies. We could see a vast outperformance, and there's a lot of good opportunities in the gold and silver mining companies that I am seeing. And if you price those miners against gold, they have absolutely ridiculously cheap valuations against gold itself. So I think there's a lot of opportunity in some of these gold and silver mining companies. I also think there's opportunities in other sectors as well. But yeah, this is a really good setup here. I said gold looks like it could lay down some performance. Booty bottom, cup and handle, and cheap inflecting valuations. So this is gold, Dow Jones. This is a cheap valuation when you value gold against Dow Jones Industrial Average. That's that booty bottom that we talk about a lot, and it's starting to break the downtrend line. That is when you take notice. We've got strengthening in this ratio. We look at the gold to M2 money supply. We've got a downtrend line that's broken just to the upside. We should be paying attention. And then we've got gold priced in US dollars. And we've got that cup and handle pattern that we're breaking to the upside. We should be paying attention to all of this. This is very important things, and we're seeing this alignment across gold priced against many other assets that it's starting to outperform. It also might mean that we could see a slowdown in the overall markets, because when gold starts to outperform a lot of other assets, that does mean something. It does mean that we could have fear in the markets, or problems could be coming in the market, whatever those problems are. Another one that I'm looking at is natural gas is looking really cheap, even cheap against platinum. And you know how I'm a platinum whore, guys. I really love platinum. And speaking of platinum, I want to make a comment here. All right. I've been buying platinum for the past few years. I just saw recently, like the past day, that premiums have increased on a lot of the websites. Premiums are starting to go up in platinum, but I just noticed that. I know it was really cheap in the year 2020, and it's gotten more expensive. It's gone up about double the actual premiums have. Maybe it's the same percent. Maybe I just don't, because the price of platinum has gone up from that time, but the premiums have gone up since I bought it in 2019, 2020, 2021. But natural gas here, looking incredibly cheap. This is Dow Jones in relationship to natural gas. Look at the level we're at, guys. This is way up there, and we're getting these wicks at the top. I do think at some point, natural gas is going to start to outperform the Dow Jones Industrial Average. When we look at the natural gas to Dow Jones, I just flipped them. You can see last kind of bear market, we basically underperformed, came to a corner, broke out of this falling wedge, and came on up. You can see the fractal in the blue line that I created. We had another bear market that came into the corner. I took this fractal and overlaid it on this one, and it looks very similar. It's basically the same movement come on down, and we can see potentially a big move to the upside. Now, I had to shrink this down. This could also be this move all right here of where we came out. Difficult to say exactly, but the fractal's there, and we'll see how big this thing runs to the upside. We've got crude oil versus natural gas at a ratio of 39. So one crude oil barrel to 39. I think that's an MMBTU, if I can remember right. And it's at 39. Very cheap in relationship to history. And then we also have platinum versus natural gas, and we're at a very cheap valuation for natural gas to head back lower. So platinum is one of the cheapest precious metals, or is the cheapest precious metal on a ratio basis. And natural gas is cheap to, I think, almost every single asset in the market. So natural gas is king for the cheapest commodity asset in the markets. This is James Anderson. He says, the holes in the ground that generate most silver ounces per year, top primary silver miners in 2021. Poland might have the largest silver-making hole, but collectively, Mexico is the land of silver dominance, Peru for a far second. So this is the millions of ounces of silver, the top 10 silver mining companies. And you can see them, Fresnillo, KGHM, Glencore. We know Glencore. This is one of our diversified mining companies that I like. Newmont, Codelco is another big copper company. Hindustan Southern Copper, another one that's a big diversified mining company. Pan American Silver, Polymetal, and Hecla Mining. Coming on down, it says notable. It says crude and condensate floating storage continues to fall down to 65.1 million barrels, according to the IEA. That's half the level of a year ago and lower than before COVID-19 hit in early 2020. Iran has sold a lot of its floating storage. We're looking at deficits in oil quarter 2, quarter 3, quarter 4. And we've got a decline here in our inventory levels of floating storage. We've got a decline in inventory levels on shore. So things are getting tighter. The deficits are going to kick up and get more aggressive as time goes on. And I have a feeling that there's going to be very strong upward pressure on prices from this point forward. We've got Art Berman here. He says, energy substitution is a doomsday strategy that condemns civilization to its status quo path of growth and biophysical destruction. No amount of non-fossil energy will make a difference until we lower total energy consumption and accept its consequence of no growth. It is unreasonable to expect fossil energy use to decline by substitution. Renewable is 5% of world energy use, and other non-fossil is 22% of total use. Lower total consumption is the only reasonable way to approach to climate change. And this is the population growth going up quite quickly, and gas, oil, and coal are going up dramatically as well if you look at the size of each of these colors. And renewable, I don't think, is going to take a large enough chunk away from fossil fuels with an increasing population. This is Warren. He says, March CPI, the good news, CPI decelerated at 5% year over year. The bad news, a 32% oil decline year over year could only pull inflation down to 5%. This is the first month ever where oil was down more than 15% and CPI was still at or above 5%. So there's a couple of things that I want to talk about here. The first one is obviously this chart. You can see where this is at. This is last month. This is your headline CPI. So it's at 5% here, and we saw negative pricing for oil. That's crude year over year change of oil. And we're in basically an anomaly here. We are knocking out anomalies everywhere. Everywhere. We're knocking out anomalies everywhere. This is an anomaly. Look, this is the furthest up and furthest to the left is this point here. We've got 1 point under here too. There's only a few points in this quadrant if you were to say this is a quadrant over here. There's not too many. We're also seeing that in the housing market. There's things that are happening where we saw a decline in pricing in some cities where they had very low inventories. And there's other things that pop up too. It just seems like we've got a lot of anomalies occurring in the markets, a lot of them. And that could be analogous to the market conditions that we're in, which could be a very bad stagflationary environment that could potentially be coming. Again, this is the updated IEA world demand supply balance. Shows the oil market going into deficit in quarter 2, 2023, which is this quarter. That's that deficit that I'm talking about. We've got a deficit and it grows. These deficits start to grow. That's minus 2 million barrels, much just like in 2021. This deficit is also expected to grow over time. So we'll see what the demand side does. Obviously, these are projections. And if this were to materialize and we get large deficits, it's going to eat through our inventory levels, putting upward pressure on pricing of oil. This one is silver, looks ready to take off. The target is $145 in about 4 years if we get back to the 2011 levels versus the SPX. We can obviously overshoot on smaller time frames. So I thought this was kind of a cool one. This is a ratio chart of silver versus the S&P 500. We've had a downtrend, a move higher, another downtrend. That's that kind of booty bottom if you put the early breakout line. And we're starting to head higher with silver outperforming the S&P 500. Hopefully we can get all the way up there. It's going to take some time. I don't expect it to be immediate. These are long-term, big picture views and trends in the markets. So that's what we've got there. Cornerstone Analytics says, well, someone want to let the IEA know that global oil demand today is already over 101.9 million barrels per day. Because that's what it says. It'll climb to this, but we're already over that. So that's kind of interesting. But that's what I've got for today, guys. We're already at 21 minutes. I'm not going to share the other one. I can save that for another day. But yeah, lots of stuff going on in the markets. Oil is going to get real tight here. We can see the oil price is sitting actually at a pretty good location for a potential move on up. Natural gas is still dragging the bottom. And I do think that it's at a very cheap ratio. It's something to look at and some of the companies to evaluate, I think, because of that ratio. And obviously gold, silver, still looking very good. In the short term, looking at the market conditions, are we going to get a fear problem in the banking system, something to happen there? I think there's a high probability that something could happen. That's why gold is starting to outperform all these other assets. And that is a first sign of a changing market condition. So that's what I've got for today, guys. Give me a thumb up for the content, subscribe to the channel, subscribe to the website if you guys would like, and we'll catch you next time. This is Finding Value.